95% of traders are afraid of market crashes, but I have turned every single market crash into an income opportunity. I've profited tens of thousands since 2018 just from market crashes alone. Today, I'll show you the volatility strategy I use when the market is in fear. Every time the market crashes, I short the volatility. The win rate of these trades are extremely high. Volatility is the only asset class that always mean reverts. So it means after every time it spikes, it collapses back to baseline. These trades have a near certain outcome. The only variable is the timing of these trades. Let me show you some historical evidence of how the VIX behaves and how volatility behaves. Okay, it always mean reverts. It is impossible mathematically for the VIX to remain high forever. So this is a very recent example. We had a market crash recently and the VIX spiked up. And now that the market is continue going higher, all-time highs again, it dropped back down. This pattern is consistent. Every single major volatility spike in the market eventually collapsed. It doesn't matter if it's geopolitical shocks like wars, earning events, or macro surprises, it doesn't matter. VIX can never stay elevated forever. It's a directional edge that is 100%. But there is a risk. The risk is the entry timing is the only variable. When do you enter? When do you actually short? When is it considered a good enough spike for you to enter? We'll be talking about that in a little bit. I have some more historical evidence, so I zoomed out a little bit more, and these are two more recent spikes. You can see it spiked up and it went back down. So you can see VIX can never stay high forever. And this holds true across multiple market cycles and volatility regimes. The spikes are always temporary. Let's look at some long-term VIX behaviors. Okay, here we have another picture. I just zoomed out more and I marked all the spikes with these yellow arrows. And you can see every time it spikes, it goes back down. I think now you guys got the feel of where I'm getting at. The strategy to profit when the market is crashing is to short the volatility. Most of the time, VIX spends the majority of its time in 10 to 20 range. Every time it goes above that, when it hits like 24, 25, it always goes back down. The only question is when. And we don't get these trades every day. So we need a way to quantify when to short the VIX. So we will use the VVIX as the indicator. I always have an alert set at VVIX above 120. I will get an alert and then I'm going to short the VIX then. That's my rule. Let me talk about what is VVIX. VVIX is the volatility of the VIX. So it is the IV of the VIX itself. You cannot trade VVIX. It is simply just kind of like an indicator for us to use. When it's above 120, this is your high conviction entry trigger. When the VVIX is elevated, VIX itself is usually already overextended. The mean reversion trade has maximum edge at these levels. But you need patience because VVIX crossing 120 doesn't happen too often. I would say it happens a few times a year. So these trades are not a monthly thing. It is more of a maybe quarterly thing or 3 times a year. Forcing entries below this threshold of 120 increases risk and reduces the win rate significantly. So you have to be very patient. We have to cherry pick our entries. So this is a chart of VVIX. I marked the 120 level with a yellow line, and you can see that it doesn't happen too often. And that's good. We don't want to be going in all the time. We want to time a real market crash, or at least a semi-severe market crash. And because these trades are pretty high percentage, we don't need to be throwing these on all the time. We want to be picky. So now I'm going to talk a little bit about the execution. How do we short volatility? The first way and the most simple way is to short the VIX futures itself. You can't trade the VIX itself, so you have to trade the futures of it. The second way is to short the VXX or the UVXY. These are leverage ETFs and they're very liquid and they're very accessible. But when you short them, there is borrowing costs and there is decay, so we gotta watch out for that. Another way is to long the SVXY. This is an inverse VIX ETF, okay? So when you long this instrument, you're essentially shorting the VIX. It's simpler than shorting, but it still has tail risk. It is also very liquid and it's a very popular and highly traded product. It's very nice because you can just go long, you don't need to borrow anything. I have to point out that not all these vehicles are equal, okay? Some are more dangerous than others. Some have borrowing costs. Some requires more trading permissions. And some are defined, some are risk defined, some are not risk defined. For example, if you short something, the VIX future or the UVXY, you have unlimited risk. COVID in 2020, the VIX popped up to 80 points. So that killed a lot of people that were shorting the VIX. So there is risk. You can also do option strategies on these instruments. For example, if you want to long the SVXY, you can choose to buy deep in the money calls. Or you can choose to do a bull put spread on it. They all have options, option chains for them. So you can do that. Or if you want to short the UVXY, you can maybe do a bear call spread or a short call on it. Now, there are infinite different combinations of strategies that you can do on it, especially when we're talking about options. That is out of the scope of this lesson because if I were to talk about it, I probably need a video for each of those strategies. What I want to do is just give you guys a taste of the various instruments you can use to short volatility with, and you guys go research a little bit about VXX, about SVXY, and about the VIX futures. I want to introduce you to this strategy of shorting volatility. Now, risk management. Again, nothing is 100%. The only thing 100% is when VIX spikes, it will come back down. The directional play, that is 100%. However, there's a catch to it. Shorting volatility is all about timing. Volatility can stay elevated far longer than expected during certain regimes. It's not always a spike and back down the next week. It's not always like that. Most of the time it is, but it doesn't mean it's always. The past doesn't predict the future. The key takeaway is the trade is right. The edge is also right. The only question is, can you wait long enough for the market to agree with you? So we need to wait for the VVIX to be above 120. Don't chase those early entries. We want to make sure that the market is actually crashing. It's a severe enough crash. It's a big enough spike that's worthwhile for us to short. That's where the VVIX up over 120 comes into play. We need to size conservatively, okay? You have to survive the wait. We don't want to deploy all our capital on the first spike. You don't want to use up all your margin power on the first strike. And also the most important part is we need to respect extended regimes. Some spikes last weeks to months. Some last couple of months. We never know how long it will take. So that's when the timing comes into play. Imagine you sold a short call, for example, and it's only 30 days and the volatility is still high and it never came back down. Then you would have lost money. Not because the trade is not working, it's just because your timing, 30 days is not enough. So maybe we need to do 90 days or 120 days short calls. Not telling you should do short calls. That's a different topic itself. But I'm just saying we have to be mindful of the DTE of the options we choose to play with. That is the case for going long or short options. All right, traders, trade small, trade safe.